Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Argan Inc. Annual Report. Argan Inc. provides a wide range of services to various industries through its subsidiaries. The company's primary focus is on the power generation market in the U.S., Republic of Ireland, and UK. Its power industry services segment offers engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services for large-scale energy projects such as biomass plants, wind farms, battery storage, and solar fields. In addition to its power industry services, Argan also provides industrial construction services that include field services supporting new plant construction, maintenance turnarounds, shutdowns, and emergency mobilizations. The company's telecommunications infrastructure services segment offers trenchless directional boring, excavation for underground communication and power networks, aerial cabling, high and low voltage electric lines, and private area outdoor lighting systems. Argan serves a diverse range of clients including independent power project owners, public utilities, power plant heavy equipment suppliers, commercial firms, electricity cooperatives, state and local government agencies, counties and municipalities, technology-oriented government contracting firms, and federal government customers. The company's services cater to various industries, providing a comprehensive solution for its clients' needs. Argan services can be summarized into the following key areas: power industry services, engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting industrial construction services, field services supporting new plant construction, maintenance turnarounds, shutdowns, and emergency mobilizations, telecommunications infrastructure services, trenchless directional boring, excavation for underground communication and power networks, aerial cabling, high and low voltage electric lines, private area outdoor lighting systems, and buried cable installation. Overall, Argan's diverse range of services makes it a one-stop shop for clients in various industries. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth are multifaceted and varied across different segments. In the power segment, growth is driven by independent power producers, public utilities, and commercial firms with significant power requirements. The industrial segment experiences growth due to new plant construction and additions in the southeast region of the U.S., as well as maintenance turnarounds and emergency mobilizations for industrial operations. The teledata segment also contributes to revenue growth through project management, construction, installation, maintenance, repair, and emergency response services across power distribution and information, communications, and data networks. Additionally, an increase in project backlog from $1.3 billion to $2.7 billion, expansion of international operations, success of power plant construction projects, and increased demand for new power generation projects all contribute to revenue growth. On the other hand, the primary drivers of revenue decline include risks and uncertainties associated with variable consideration, changes in scope and price of contracts, claims, incentives, and liquidated damages. Contract terminations for convenience, fluctuations in commodity prices, tariffs and trade policy changes affecting construction material costs, and cost overruns also contribute to revenue decline. Furthermore, variations in estimated contract costs and revenues, changes in interest rates, uncertainty associated with variable consideration, disallowed research and development tax credits, unrecognized income tax benefits, and recognition of foreign NOL income tax benefits all have an impact on revenue growth or decline. The net income of the company experienced significant fluctuations over the 3 fiscal years from 2024 to 2026. In fiscal 2024, the net income was $32,358, which decreased by 62% compared to fiscal 2025 and 61% compared to fiscal 2026. However, in fiscal 2026, the net income surged to $137,774, a 61.2% increase from fiscal 2025. The improvement in net income can be attributed to several factors. Firstly, the recognition of previously unrecorded revenue from contracts contributed significantly to the increase. Additionally, the reduction in potential liquidated damages and recovery of costs through contract modifications and claims also played a crucial role. These factors collectively led to an increase in net income margin from 5.65% in 2024 to 9.79% in 2025. Profit margins also underwent significant changes during this period. The gross profit margin increased from 14.1% in fiscal 2024 to 16.1% in fiscal 2025, a 13% improvement. Similarly, the operating profit margin improved from 8.28% in fiscal 2024 to 17.64% in fiscal 2025, a substantial increase of 113%. The decrease in provision for income taxes and increased efficiency on active projects were key contributors to this improvement. Overall, the net income and profit margins of the company experienced significant changes over the 3 fiscal years. While there was a decline in net income in fiscal 2024, the subsequent years saw a substantial increase due to various factors such as recognition of unrecorded revenue, reduction in potential liquidated damages, and recovery of costs through contract modifications and claims. The company's financial performance indicates a positive trend in its operating cash flow. According to the provided information, the net amount of cash generated from operating activities for fiscal 2026 was a significant $414.7 million. This substantial figure confirms that the company is indeed generating positive operating cash flow, as stated on page 31 and further supported by page 57, which also reports the same amount of $414,718. The company's debt level has undergone a notable decrease. As of January 31, 2026, there were no borrowings outstanding under the credit agreement, indicating a significant reduction from previous years. Furthermore, total debt decreased from $379,874 in 2025 to $555,500 in 2026. In terms of interest expenses, while some fluctuations are observed, there is no explicit indication of a significant change. The company reported interest expenses of $901 in 2026, which is lower than the $1,237 incurred in 2025, but higher than the -$3,899 recorded in 2024. The performance of various segments and regions within a company has been analyzed based on recent data. The power segment stood out as one of the top performers, with significant projects in the US, Ireland, and the UK contributing to its success. This segment saw an increase in project backlog from $1.4 billion to $2.9 billion. The industrial segment also performed well, primarily located in the southeast region of the U.S. The teledata segment, however, struggled with declining revenue from fiscal 2024 to fiscal 2025, although it showed a slight increase in fiscal 2026. On a regional level, Ireland and the UK's power markets excelled, while the southeastern U.S. saw growth in the industrial segment. These regions offer potential opportunities for expansion, particularly in overseas power markets and industrial construction in the southeastern U.S. Management's outlook on the company's strategy and future developments is optimistic. They anticipate a favorable impact from future developments and are committed to identifying companies with significant potential for profitable growth through opportunistic acquisitions and investments. The company plans to operate in multiple industrial focuses depending on opportunity and customer needs, while prioritizing long-term value creation for shareholders. Specifically, they aim to construct state-of-the-art natural gas-fired power plants as part of the country's electricity generation mix, targeting opportunities in the US, Ireland, and UK. Management believes that the power market outlook is favorable due to increasing electricity demand in the US, making natural gas-fired generation a critical component of the U.S. generation mix. They have a strong pipeline of project opportunities in power generation and are pursuing selective construction opportunities in other markets with ambitious renewable energy objectives. In terms of funding, management believes that cash on hand, cash equivalents, and future operations will be adequate to meet general business needs, but may require additional funds through debt and/or equity securities for significant future acquisitions or investments. They also plan to continue evaluating opportunities for alternative energy project investments and selectively participate in power plant project development and related financing activities. Overall, management's strategy is focused on creating long-term value for shareholders while navigating the changing regulatory landscape, including the impact of the One Big Beautiful Bill Act, OBBBA, on tax deductibility and foreign tax credits. The company has a history of rewarding its shareholders through two key methods: paying dividends and buying back shares. The extracted summaries reveal that the company has consistently paid dividends, as indicated by multiple page references. This suggests a commitment to returning value to its investors. Furthermore, the company has also engaged in share buybacks, which is another way to return value to shareholders. The presence of multiple page references for this activity confirms that it is a regular practice within the company. Concerns about inventory buildup and supply chain disruption are prevalent in various aspects of the industry. On one hand, there is a risk of inventory buildup due to an increase in project backlogs, as seen on page 3. This can lead to delays in construction timelines, further exacerbated by supply chain constraints mentioned on page 4. Moreover, changes in trade policies and regulations may cause import delays, longer lead times, or supply chain disruptions, page 13. The industry is also facing challenges related to the availability of experienced EPC contractors, specialized labor, major equipment manufacturing capacity, and project development timelines, page 29. Additionally, tariffs imposed on materials can increase costs, lead times, contribute to delivery delays, and negatively impact project costs and schedules, page 38. Furthermore, an increase in raw materials inventory from $320 to $10,978, page 82, indicates a potential buildup of inventory. The power segment has also seen a significant increase in project backlog by $1.4 billion, page 30, which may lead to further concerns about inventory buildup. Overall, these concerns highlight the need for careful planning and management of supply chains and inventories to mitigate potential disruptions and delays. That concludes the financial summary for Argan Inc. Feel free to comment below, and I will be happy to answer them when possible.